I just want to go back to that Deutsche Bank note. You know, they do have a point. Some of the weakness we've seen recently has been driven by a small group of stocks. However, that small group are technology stocks. Tech down about 5% or more in the third quarter. Those are the stocks that were leading the market for most of the year. Is that a concern that those are the stocks leading the declines, even though it is a small number?
I don't think so, and I want to separate two things, right? There's the market declines, and there's this general fear of a recession in the economy itself. And I agree with Deutsche Bank on the latter. For now, this is pretty much ado about nothing. And I just want to set the goalposts here. When we saw inflation come down out of that 30 to 40 basis points month-over-month core that we were stuck in for 16, 18 months, what is inextricably linked with that is the jump in unemployment, because it was the wage growth that was driving that. And so if we're going to get out of that inflationary paradigm into something that is more neutral, we should have expected a lower jobs number to correspond with that 4.2 or 4.3% unemployment. We should have expected a weak ISM in manufacturing, which we've had, by the way, Frank, for 21 of 22 months. So none of this was expected, and I'm surprised that the market has reacted the way it has. Keeps me neutral.
All right, so you're neutral right now. You're saying it's much ado about nothing, but I want to go to the earnings estimates for next quarter, or actually, I should say the current quarter for Q3. They're about half of what they were for Q2. I mean, isn't that a sign of concern? Isn't that a sign of a dramatic slowdown that Deutsche Bank says you shouldn't over-exaggerate, but maybe you should focus on?
Right. Well, first I'd note that consensus is notoriously off when it comes both on the up and the downside. But Frank, you're comparing that to a number which was 11% for Q2, which was the highest we've seen since the fourth quarter of 2021. So the basis of that comparison sets a really high bar. If we delivered 6 or 7% earnings growth, I don't know if that's indicative of a recession, particularly when we've seen 4 straight quarters of GDP growth, when we saw the second quarter double the pace of the first quarter, and when we'll likely top 3% in the third quarter. That doesn't seem like a weakening economy to me.
Greg, one last question. I need a quick answer, though. We got to get out of here. Rate cuts, 25, 50 basis points. Does that matter? Would 50 basis points possibly spook the market? We have a number of guests that says that could actually scare the market and actually lead to more declines.
Look, we're in unpredictable territory. I don't think so. I don't think so because the consensus expectation for a 50 bip rate cut was about 40% just 2 weeks ago. It sits at about 30 right now.